Okay, ladies and gentlemen, we're going to move now to the next session, and obviously there's some overlap here with some of the discussions that we've been having already, because we're again focusing on financial markets, but just hopefully we're going to drill down a bit more and look at the outlook for Greece. We're going to be joined by connection by Paolo Fioretti, who is the Mission Chief for Greece at the European Stability Mechanism. And we will also be joined by Julia Lendvai, who is the Mission Chief for Greece at the European Commission. And I'm delighted to have here George Chouliarakis, who is the Senior Fellow now at the Harvard Kennedy School, and a former alternate Minister of Finance, and I'm sure you all remember George, and it's great to have you back at one of our events. Unfortunately, Michael Argyru, the chairman of the Council of Economic Advisors of Greece, is unable to join us. So that's unfortunate, but I guess it's going to help us in terms of catching up with the schedule and having a good discussion before lunch. So let's turn immediately to Paolo Fioretti. Welcome. Thank you very much for joining us, and I'm going to hand over to you now to make your introductory remarks.
Thank you. Thank you very much for the invitation. For me, it's a pleasure to be here to speak about Greece. My short introduction will touch mainly 3 points, 3 remarks. One is on what is different today from the past for Greece to manage this crisis. What should be done to solve the potential problem of a potential new wave of NPLs. What the country should focus, and I want also to do some remarks on the investments, the importance for the recovery, and the capacity to improve the sustainability of the long-term growth. Okay, now it's clear that over a decade of adjustment, Greece has restored its sustainability, the sustainability of its public finances, strengthened the banking sector resilience, and also improved the competitivity of its economy. This has allowed the country to regain market access that is, at the end, is the ultimate goal of any adjustment program through which Greece went in the past years. Thanks to this adjustment and the fact that Greece has now stronger fundamentals, the country has been able to maintain market access even during the pandemic outbreak. This is clearly something completely different from the past, where Greece lost market access. So this makes a huge difference. Indeed, during the lockdown and in the following months, Greece was able to have several issues, 2-3 issues, collecting 7.5 billion. But the important thing is that it was done thanks to strong investor demand, with the spread that remained contained and even declining over time. And this was possible because, first of all, Greece entered in the current crisis in a relatively favorable fiscal position for 3 reasons. First, because it has now substantial cash reserves. It had a strong primary surplus, and in particular, the country has a low medium-term refinancing needs on its public debt. And second, and also important, is that a second element that allow Greece to maintain market access is that the Greek government reacted very quickly and very well in a very effective way in implementing measures to tackle the effect and the spread of the pandemic. However, this is a completely different type of crisis, and we are completely unprecedented times, and where countries are experiencing face large fiscal deficit and increasing debt levels. And this means that the governments will have will need to be ready to face a worsening of the situation, and while are also in the while preparing to restore public finances once the situation normalizes. This means that it's important that all these measures, at least from my point of view, should be the measure to tackle the immediate pandemic effect should therefore be considered as temporary and replaced by reforms aimed at boosting the potential growth. This is crucial because to preserve the medium-term debt sustainability, and also crucial to maintain the market access. The second point I want to do is on the banking sector and the NPEs, because a necessary critical condition for the economy to recover is that to have sufficient financing for companies and citizens. This means to have an efficient banking sector. This means that Greece, but also all the other countries, have to focus on fixing the weaknesses in the banking sector. And for Greece, this means also to manage, to tackle the legacy problem of NPEs. But this means this is not sufficient, because focusing only on the past, because we can expect a new wave of NPEs, and this means that it's important from my point of view that the country focus on try to design the country and the banks a comprehensive strategy to tackle this expected second wave of NPEs. And in particular, once the measures recently introduced will be lifted. Also, other panelists in previous sections referred to the insolvency law. This is clearly a right step, a step in the right direction. That it's a law that will be legislated by the government and provide. It's really a right tool for preventive restructuring, also for the future. Obviously, it has to be. It has to go together with the other reforms, for example, judicial reform and training of judges and others. And last remark I want to do is on investment. It's investments, and to have looking forward to have the country, Greece, but also other countries, they need to unlock the full potential of public and private investment, and this should be a priority, because it's key to for a speedy recovery of the economy, but also for a sustainable long-term growth. Going to the specific of Greece, this concern is the past undershooting of public investment expenditure. Because the country has now large investment needs, and this means that it's crucial for the country to do the best use of the European funds now available to deliver the needed stimulus and restart growth. We know that there is a package, a first package of 540 million, including 3 safety nets. One is provided by my institution, the PCS, the Pandemic Credit Support Line, that is for sovereign to cover the health expenditure. Then there is the loans provided by the European Investment Bank to support the economy and the companies, and there is a third safety net from the Commission for citizens mainly. That was approved in May. This money is already available now, and it's important that the countries start planning to do a good use. A second package has been approved in July. It's this huge amount of 750 billion, the Next Generation EU package, that will be available in the next month. So there is a huge amount of money available. And to conclude, I think that it's important for Greece, the country, to design ambitious and effective growth strategy and implement it, and focus it on implementing, because all this amount of fund is once in a lifetime, and it's important to use at the best these funds. And continue with the reform, because it's the only way to have a good recovery, a speedy recovery, and sustainable, and to improve the sustainability of the growth in the long term. I stop here. Thank you very much.
Thank you very much, Mr. Fioretti. And I trust you're going to stay with us and for the discussion afterwards. I'm sure we'll have time for some questions afterwards. So I'm going to turn now to Julia Lendvai, the Mission Chief for Greece for the European Commission. Welcome, Julia. Thanks for joining us.
Thank you for the invitation, and it's a pleasure and an honor to be on this panel. It's a big shame that I could not travel to the beautiful Lagonisi resort. I hope I can do it next year, maybe. So thanks also to Paolo for his remarks, and maybe let me start with a couple of words about the current situation. Now, it's clear that there are currently huge uncertainties around the evolution of the pandemic and the potential scars that it will leave on the global economy. So it is extremely difficult to make short-term forecasts, even not to mention the long-term ones that are needed to carry out a proper debt sustainability analysis. Now, this being said, there is no doubt that the Greek economy is currently taking a relatively big hit. And this will obviously also result in the increase of the public debt to GDP ratio, which was already very high before the crisis. So it will increase even further. But I think it is important to keep in mind that, first of all, as Paolo just said, Greece has successfully tapped the markets in the past months since the beginning of the pandemic crisis. And it was not only for short-term issuances, but also for long-term bonds. And there are some critical elements to this, which is, first of all, Greece's debt refinancing needs are fairly limited in the coming years. They remain around 4 to 5% of GDP over the next decade, which is a very good basis to keep the overall gross financing needs also manageable. Greece has considerable cash reserves, which also provide a cushion to absorb liquidity shocks. And obviously the fall in the spreads and yields, which is obviously primarily driven by the ECB's pandemic emergency purchase program, is also very helpful in this regard. And finally, it's very important to point out that the increase in the debt to GDP ratio for the time being is mostly driven by the expected fall in GDP, as opposed to the increase really in the stock of debt. So should there be a fast recovery, as we hope there will be, but obviously it will depend also on the pandemic's evolution, it would also lead to a relatively fast drop in the debt to GDP ratio. Now, this brings me to the main message that I would like to pass, and this is that beyond hoping for a fast way out of the pandemic, what will be critical for the sustainability of public debt in the medium and long run is obviously, as has been mentioned by Paolo, as has been discussed in previous sessions, it will be to ensure sustainable growth. And as it has also been mentioned by Minister Staikouras in his speech earlier, the EU has been mobilizing a substantial amount of support to help countries facing the crisis, of which Greece will be among the largest beneficiaries, actually. Greece can receive around 10% of GDP in grants under various next generation EU programs to which Greece can also benefit of favorable condition loans amounting to a further 6.7% of GDP. And these funds will be available very fast, starting from next year, and come on top of the EU cohesion and social funds, which are additionally 1.5 to 2% of GDP. Not to mention actually the S&P ANFA income equivalents, which can be transferred to Greece under the ongoing enhanced surveillance, which amount to an additional 0.8% of GDP annually. So altogether, Greece can benefit in the coming years of about 5% of GDP in transfers only annually. Now, it will be essential to grab the opportunity and to spend these funds in a meaningful way to support growth while continuing the modernization of the Greek economy. This will require, in the first place, reforms to enhance the absorption and planning capacity of public administration. And in this respect, the government's initiatives to set up a strategic project pipeline and project preparation facility are most welcome. Strong controls over the spending of funds will also be needed, and the government is currently preparing a public procurement bill to address the weaknesses of the framework. This is also very welcome. Another element that will be critical is the strong reform agenda. It has also been discussed in previous sessions. The main elements of the reform agenda are, of course, well known and have been pursued under past financial assistance programs, are still being pursued under enhanced surveillance, and it will be important to build on those, and Minister Staikouras has also outlined them earlier today. I'm talking or having in mind fiscal structural reforms, including that of the tax administration, which needs to continue, labor market, education and skills reforms. Obviously, as Paolo just mentioned and Francesco in the previous section, the financial sector stability needs to be ensured, in which the adoption of the insolvency code will be a key step. Business environment needs to be, the reforms need to continue, including licensing procedures, cadastre, land use, and obviously modernizing the court system and increasing judicial efficiency will also be important. Now, it's very good. The government is going to finalize its national reform plan pretty soon, and it's a solid basis to build on, as also Declan said in the previous session. Of course, the devil lies in the details and will need to be worked out in the coming weeks and months, and the Commission will be engaging with the authorities at technical level also. Now, much of this is not new, as I said, and the RRF gives funding to pursue this agenda. Of course, the RRF is going to give priority to sustainable growth, but also with a focus on the twin transition towards green and digital economies. And the last element that will be key, of course, is the continued implementation, which has been the Achilles heel of successive Greek reform initiatives and programs. But I do hope that the government's strong ownership of the reforms will be a good basis in this respect. Let me stop here. Thanks.
Thanks very much indeed, Julia. So stay online, obviously, and we'll be coming back to you with questions afterwards. So let me turn now to George Chouliarakis. I'm very interested to hear your perspective now on, I guess, all that you've heard so far, particularly on this question of what should be the proper balance between sustainable growth and sustainable public finances. I mean, is that just the same old debate, actually, that we've been having since the eruption of the Greece crisis, or has something qualitatively changed because of the pandemic? So anyway, that's a question that you can maybe come back to later, but let's hear.
Yeah, I don't think, first of all, thank you for inviting me, and it's a pleasure for me to be back here after a year or so. I don't think the trade-off between the two is as steep as it used to be, but let me start by taking an overview of the state of capital markets globally. So 2020 has witnessed a record debt issuance, maybe the highest since 2008 across the world. And debt has increased substantially in the European Union by somewhere in the territory of 15 to 20%. It has gone up in the United States and Japan by somewhere between 25 and 30%. And interestingly, same goes for many emerging markets and developing economies. Typically, capital markets cannot be used as a buffer in times of crisis in emerging market and developing economies. We are all familiar with the cycle of capital markets shutting, capital inflows reversing, and therefore capital outflows sudden stops, forcing emerging market economies and developing economies to pursue pro-cyclical policies in times of crisis. But this time around, I think they acted as a shock absorber in an unusual fashion, and therefore enable even emerging market economies and developing economies to pursue counter-cyclical policies. So a key question to ask, and a question that I keep asking myself, is why are markets so relaxed this time around? Is it that debt sustainability is no longer on top of minds as far as capital markets go? And I think the answer is pretty straightforward. As far as Europe goes, the key was the quick and decisive action on the part of the European Central Bank with the pandemic emergency purchasing program Mark I and Mark II, and of course later on the coordination between fiscal and monetary policies in Europe with the fleshing out of the Recovery and Resilience Fund of the European Union. And at global level, I think the Fed played a very important role, both in lowering interest rates as well as extending currency swap lines to emerging market economies. So all in all, monetary policy action was key, and policy coordination overall was key to calm market sentiment and convey the message that what economists would call R minus G, that is the difference between the nominal interest rate on one hand and the nominal growth rate of output on the other, the driver, if you like, the automatic driver of debt sustainability will remain negative for the years to come. And of course, a negative R minus G allowed for at least some room for fiscal stimulus. Now, there is plenty of heterogeneity in the way countries responded to the degree to which they responded, if you like, to the COVID-19 crisis. Some countries responded much more aggressively than others. I think Greece is on the lower bound of the extent to which it pursued discretionary fiscal stimulus, but overall the reaction across the globe was good. Does this mean that markets' mind shifted in a fundamental way, a way of debt sustainability questions, or are we expecting to see again sustainability concerns re-emerging? And my key message here is that we shouldn't derive too much comfort from the way markets have responded. So far, it's not unlikely that fragility can resurface, especially in the emerging market economies and as far as Europe goes, in the periphery of Europe, to those countries that were most affected by the COVID-19 crisis, and Greece is one of them. Does this mean that we are back exactly to the question you put on a steep trade-off between sustainability and recovery? Do policymakers, do authorities have again to choose between accommodating a sustained economic recovery on one hand and taking care of sustainability on the other? To my mind, this trade-off is not as steep as it used to be. And the key risk, the immediate key risk to debt sustainability at this point is a weak and fragile economic recovery, not just in the short term. I'm not talking about the quarter-on-quarter growth rates. I'm talking more about the negative impact that COVID-19 and the lack of policy initiative may have on potential growth. And therefore, the trend growth rate of an economy, and especially Greece. So how do we tread this fine line of keeping capital markets calm, containing, if you like, sustainability concerns on one hand, and stimulating economic recovery on the other. I think at this stage, and given that the COVID-19 crisis is still unfolding, we should keep in mind 6 key takeaways. First of all, there should be no premature exit from the accommodative fiscal stance. We don't yet know when the COVID-19 crisis will be over, but we know that any premature exit of fiscal stimulus will have seriously damaging effects on not just on short-term, but also on potential growth through the impact on human capital, long-term unemployment, but also physical capital, private sector indebtedness, and so on. Point number 2, keep spending, but keep spending, and maybe keep spending aggressively, but keep spending wisely with emphasis on targeted measures that can have an impact on long-term, on potential growth. And of course, the Recovery and Resilience Fund here will play a key role, but beyond this, I think the government should pursue a targeted policy of supporting those sectors that have been most affected by the COVID-19 crisis. It's been a global crisis, but in many ways it's been a sector-specific crisis. And as the economy recovers, there are sectors, especially in Greece, that will need significant support. And this support can take, I'm just giving an example, I think it's the best targeted tool, can take the form of subsidizing employment, subsidizing wages. Point number 3, there should be a way to deal with effectively private sector indebtedness. There is no question that the private sector, especially in Greece, will emerge from the crisis seriously affected, heavily indebted, and therefore even viable firms that can, if you like, produce a social good, not just a private good, but a social good for the Greek economy, may end up going bankrupt unless there is a clever mechanism, a clever device to deal with private sector indebtedness. Point number 4, turning now my attention to Europe, I think the PEP, the Pandemic Emergency Purchase Program, has to be extended for the years to come. And I think this should be a clear signal sent out to markets as early as now. It will be very important at the time of accommodative fiscal policy that markets know that there will be a buyer there, a buyer of last resort if needed, to maintain interest rates low. Point number 5, we all know that at some point a fiscal rule will have to return. It has to return. Fiscal policy should be coordinated at European level. We don't know the exact characteristics of this rule yet, but we of course know that there shouldn't be a free-for-all forever. We shouldn't, however, rush to introduce again a rule with an austerity bias built into it. So we have to be very careful and use the crisis as an opportunity to design a clever mechanism that will allow a gradual return to fiscal discipline. Again, it may take several years before we reach that point. And finally, a key takeaway message for the authorities, I think, it's not time to think in a business as usual modality. I think it's time to be bold and be aggressive and be ambitious also in the way they handle both protection as well as reallocation issues of the economy. Maybe I should stop here, and I'm happy to answer any questions you have.
Thank you very much, George. So have we got our external speakers online as well? Yes, we have, I think. So you covered a lot of ground there. In fact, you posed quite a few questions that I was going to ask and then gave your thoughts about them. But I do want to pick up on a few of them, and also Paolo and Giulia, feel free to jump in. I will ask you directly to respond to a few questions, and I encourage any questions also from the floor. Put up your hands if you do have a question. But I thought maybe we should start, since the session is about Greece and financial markets, let's stick with this question of where this is all heading, further down the line, not this year, maybe not next year, but maybe from 2022 and beyond. Obviously, at the start of all this, there was a big concern about access to financing for Greece, for Italy, and others. And lots of questions about whether we would be heading for a sovereign debt crisis at some point. Now, those concerns and fears seem to have receded, given the decisive action of the ECB, and also finally agreement on the Recovery and Resilience Fund. So a lot of concerns have abated, but I think you intimated maybe we might be too sanguine. I think our view would be that there will be sovereign debt crises in emerging markets, actually very soon, and we're already seeing debt restructurings and so on. But is this more of a medium-term problem for Europe? And what would, for those who are more fiscally constrained, more indebted, and we're looking at, I don't know what the consensus forecast is, but if we're talking about a deficit of about minus 7.5%, which is relatively modest in Greece compared with others, but we're looking at public debt, the public debt GDP ratio rising to about 200% of GDP in Greece from 180%, and similar increases in other countries as well. Now, what would cause things to change? Look at Greece. It's actually quite incredible what's happened in terms of Greece issuance, Greece access to the markets, the interest rates. We've had 10 billion in issuance in Greece so far this year, at very favorable interest rates. What could cause that to change? I think we're going to be living with a low interest rate environment for quite a long time. But when perhaps questions arise then about budget deficit targets, compliance, reform targets, and so on, could that be the moment when the markets start to change, when we might see more risk aversion? So I'd like to ask you, and also Paolo and Giulia, if you so wish to respond to that question. Yeah, are we too sanguine about this possibility?
Well, let's take a look at the key assets of the Greek authorities in this struggle against the COVID-19 crisis. I think the Greek authorities are endowed with two unique assets. On one hand, the gross financing needs of Greece are very low and will remain low for a long time to come, all the way till 2032. Most of the debt is official sector debt. Interest rates are extremely low and fixed. Maturities are long, much longer than any other European country for that matter. And of course, this offers comfort to capital markets that Greece will be able to cope, not just with the ramifications of the crisis, but also with the accommodative fiscal stance that should be pursued. Second key asset is the huge in Greek standards anyway, cash reserve that the previous authorities endowed the new authorities with. A cash reserve of nearly 20 billion euros that can be easily used, accessed and used. I'm excluding the 15.6 billion euros that are earmarked for debt repayments, that can easily be accessed and used for fiscal stimulus without the need to borrow. I think these two assets are unique in many ways. And of course, then you have the ECB and the PEP program, keeping interest rates low now and hopefully for the years to come. I think it's a key precondition of any sustained recovery that the ECB has to keep PEP in place, have to be acting as a lender of last resort, not just for this next year, but for several years to come. As I said, I wouldn't be too much worried about debt sustainability at this stage. It's not the key priority. It's the back of, it should be at the back of the minds of any policymaker, of course. I think the key priority is recovery. Recovery and debt sustainability are, flip sides of the same coin. We should do everything we can to make sure that potential growth remains where it were before the crisis, or even better, increases relative to where it was before the crisis. In 4 or 5 years' time, exactly as you put it, we can take stock and see how much consolidation may be needed and what other things may be needed to turn the Greek debt, to put the Greek debt back on a sustainable track if it's unsustainable. So I don't want to judge at this stage whether it will or not be unsustainable going forward.
Yeah. So, Mr. Fioretti, is that in conformity with your view and the view of the ESM and your colleagues? I mean, that's the first thing, just your views, to hear your views on that, whether debt sustainability is an issue really in the short to medium term for Greece and others indeed in Southern Europe. And secondly, I guess, whether you think there's been a kind of paradigm shift, if you like, in this, how we're looking at this problem of this balance between sustaining medium-term growth and debt sustainability. Has the view really shifted on that within Europe and the institutions? And Julia, I'd like to hear your thoughts as well, and you might maybe want to focus more on the growth side of the equation. And I had a follow-up question for you about institutional capacity and whether you think things have already changed in Greece in that regard over the past few years, or whether there's really a big hill to climb still. So first, Paolo, over to you.
Okay, thanks for the question. I will try to be very brief, and I tend to agree also because I agree with George. It's I think debt sustainability is not a concern in the short term. Should be more on the long term. We need to have a long term view, and but we have in the short term we have to focus. I think the authorities should focus on investments, how to make the investment plan effective, how to implement properly, quickly, to increase potential growth. This is, I think, the solution of the equation, that to invest properly, to speed up the recovery and improve the potential growth. It's about your second part of the question on the paradigm shift. I think we have, I don't know if it's a paradigm shift, but we as ESM, we are a long-term borrower. We always have a long-term view, in particular for Greece, where the loan will be fully repaid in 2070. That is quite long term. So for me, what we do now is to try to look at the medium long-term sustainability of the debt and the repayment capacity. Now, obviously, the focus has to be on investments, on the stimulus and on how to mitigate the impact of the crisis and to reignite the economy, the growth, and to increase the potential growth of the economy in Greece, but also in Europe and other countries. I stop here.
Thank you. And if I may, just to follow up on that then, you've given great emphasis to this, to investment and getting things right. So actually several speakers this morning, including previously in the previous session, Mr. Costello, have mentioned, you mentioned it also, the previous kind of track record of undershooting, persistent undershooting of public investment programs, which is not a problem unique to Greece, of course. It's a problem we see in many places. So how, given the funds available, given that this has really got to be a priority, how can the authorities in Greece ensure this doesn't happen again? Have you got any real concrete kind of advice, if you like, here on how that can be avoided, how we can make sure that the funds available really are utilized to the best possible advantage?
Is it for me?
It's for you, Paolo, yes.
Sorry, I misunderstood. No, this is a concern. It's a concern related to Greece because there was this underspending and in the past and undershooting in the investment expenditure. I have to see that we saw a recovery in the last year, despite the problems with the pandemic, but remain a concern. So it's a way to solve it is to continue with the reforms, to modernize the country, the public administration, and to have a clear strategy, I believe. I stop here.
Yes, thank you very much. Julia, just to come to you then, to give your views on any of these questions, issues that have been raised so far. And particularly on that, maybe you have a view too on this, ensuring that this public investment, on the investment program, the funds available are put to the best use. Do you think Greece has the institutional capacity to make sure that happens, that these funds are absorbed and utilized as best as possible?
Yes, thanks, Joan. And let me first start by saying that I agree with most of what was said by George and Paolo before. Obviously, the exit from emergency support measures will have to be managed carefully, but it's also not the immediate priority right now. The markets are financing the Greek debt and other debt, so I would, as I mentioned already in my intervention, the most important thing is to spend this money well and to spend this on new structures, on modernizing the economy. And it's important, as also was mentioned before, that this money does not go into old structures which do not support sustainable growth. But that's why reforms and accompanying investments will be key. Now, you have asked me the question whether there have been reforms of institutional capacity and whether it's sufficient. Now, the answer is that there have been important reforms over the past years of institutional capacity. There have been new institutions set up since 2016. Just to mention the Independent Authority for Public Revenues, but also the holding company that's also responsible for the management of state-owned enterprises and various others. And so there have been also very important reforms in the public administration to modernize its capacity and its functioning. Now, these reforms are still ongoing, and it will be very important to continue them. And also, it will be very important to continue the full build-up of the capacity of the tax administration, digitalization of tax collection, online cash registers, and so on will be crucial going forward to enlarge the tax base, which actually could be a basis for a real reform of the tax structures. And as I mentioned in my intervention, the government has set up a strategic reform pipeline, which will also be very important for the planning of key reforms. This was already started, I understand, before the RRF was adopted, but it will be even more important with the RRF. Is this enough? We will see, but I see very positive steps that are pointing in the right directions.
Okay, thank you very much, Julia. Very quickly, George, because we have to get to lunch, apparently, sure. I've been told.
Just a very quick comment. I think markets like what they see. They like the new mentality in Europe. They see the European institutions reacting quickly to invoke the escape clause and therefore let national authorities pursue stimulus. They like the way the ECB reacted. They mainly like the way that the ECB and the Commission coordinate, and they commit to coordinate going forward. And I think this gives a unique opportunity, especially for Greece, with a very solid background of correcting fiscal imbalances, of restoring credibility, of building cash buffers, to be more bold and more ambitious in stimulating the economy, provided that this is done cleverly and wisely, targeting long-term growth. I think debt sustainability issues will not reemerge.
Thanks. Yeah, well, I think that's a very good point to end on, actually, that again, several speakers, I don't know if you heard all the panels this morning, but many speakers have emphasized that this is unprecedented, not an unprecedented crisis only, but also an unprecedented opportunity that is not going to be repeated. So boldness is required for Greece and others to seize the opportunities that are presented as well. And in subsequent sessions, we're going to look more closely at the business environment, the reform agenda there, the investment agenda, and look in detail at key sectors for Greece. But I think it's been great to have both the view from the European institutions in this session, and obviously earlier, but those working most closely with Greece at the Commission and the ESM, and to hear the views from somebody who's now a bit of an outsider, but who'd previously been very much an insider on this really critical moment. So thank you all very much indeed. Thank you for your remarks and for answering the questions. And we're going to now stop for lunch. Thanks all of you for listening, and we'll be reconvening in about an hour and a half. Thanks again.